And Keith Emery is the Director of Operations at Credit Canada Debt Solutions. It's nice to see you both. And Francis, I'd like to start with you on the big picture. What does this tell us about sort of the broader health of the Canadian economy that they're willing to hike rates now?
Well, Governor Pola has actually said today the fact that they were hiking interest rates is good news for the Canadian economy. And I don't think he meant that the interest rates themselves were actually good news. But what he was trying to imply is that this is an economy that can withstand 25 basis points of incremental hikes, gradual tightening. That means that the economy is doing well. The jobs are doing well. Exports are bouncing back. And they have the expectation that business investment is going to come back strong as well.
And Keith, we've had 2,500 days of low interest rates and people that, frankly, have never known other than very cheap money. What impact will this actually have on people and their borrowing and their ability to pay off their debt?
Right. So on a direct level, people who are on variable rate debt, whether that be home equity lines of credit or variable rate mortgages, they're obviously going to see a slight increase in their payments and their mortgage fees. A quarter point itself might not completely, rock people's boats. But as you said, what does this mean long term? People really need to look at where they are at in terms of making their payments on variable rate debt and consider how much debt they're carrying.
If this is a spark, it might not actually change behavior, but there might be somebody at home who's like, whoa, rates are finally going up. They said it's been coming. It seems to be upon me. It's time for me to get my financial house in order. What's the first thing that they should do?
Stress test. This is advice we gave even before rates are going up. You want to take a look, maybe find an online debt calculator somewhere, plug in your interest rate plus 1%, maybe plus 2%, see how much your payment goes up, and then see how your budget would react if that happens.
Francis, let's game this out. I think you're looking for the next hike to come in October, not in September. First of all, why is that? And then, if you can, just give me a sense of what you think the new normal is going to be. Where are we going with rates?
Well, that's right. We are expecting the next rate hike in October, and that's because of a generally hawkish tone from the Bank of Canada today. What was surprising wasn't so much that they hiked interest rates. That was well understood. It was the context around how they framed it, not so much about the removal of those two cuts that they put in place in 2015, but much more about upside risks to the economy, upside risks to inflation and growth. That says to us that the Bank of Canada isn't just reinstating those cuts, but actually moving towards a longer-term path of hikes. October seems like a good base case. That'll give them about 4 inflation prints to judge how the economy is doing. They also revised their forecasts in October, so it's a good time to do it. They might take a little bit of a pause afterwards to see how the economy responds to 2 rate hikes, and then we see another one coming in January of next year as they do move towards a normalization, rates above 1%.
And is that, like, when you talk about normal and normalization, is like 1.5 about where you think normal might sort of find its sort of balancing point?
Well, this is the really big challenge for central banks is how do we compare today to the past? We have all sorts of structural changes that mean that the natural rate or where rates should be is probably different today than it was 10 years ago. Things like demographics, lower productivity, the structures of the economy. So central banks are really wrestling with what should the neutral rate of interest be. It's probably closer to 1.5% to 2% than it has been in the past.
So, Keith, at 2%, we hear all of these stories about how just right on the cusp a lot of Canadians are.
Yeah.
How accurate is that picture, and what happens at 2%?
For some of our clients, it doesn't look pretty at 2%, I've got to be honest. We look at a lot of our clients, they usually have in the range of maybe $200 of surplus income in their budget. At 2%, a 1% increase, or 1.25, I guess, or where we're at now. That's going to eat up that $200 and more.
Right.
So they're going to be underwater budget-wise. I think Manulife themselves actually even did a study that talked about how much people, their interest rates could, how much they could absorb. And I think it was somewhere in the neighborhood of like 40% wouldn't be able to cope with that kind of an interest rate increase.
And yet, money's still very cheap right now. I mean, this quarter-point rate doesn't change that fundamental. Is now the time for people that have multiple debts consolidate them, get them under one roof, get them under one lower rate, and try to get them paid off before you get to 1.5 or 2?
Yeah, absolutely. It's wake up call time. That's the positive thing is maybe people will get the message. Make moves now to prepare for that potential inevitability. Tighten up your budget. Look for extra income. Reconsider whether you want that home renovation on your HELOC. Try and bring your debt down. Easier said than done, but time to get aggressive.
Francis, what stands out for you as the risks as we get into this new environment of, not knowing where interest rates go? There's still an awful lot of risks that the bank itself has highlighted.
Absolutely. But what's interesting about the current environment, and probably why the Bank of Canada felt the need to move forward, is that we have both upside risks and downside risks. We've been focused a lot on the downside risks to the economy, things like NAFTA renegotiations, of course, if we see a hard landing in Ontario housing. But the Bank of Canada today was trying to emphasize there are upside risks to the economy as well. Business investment taking off, a strong U.S. economy, a strong global recovery. So they're trying to balance those two. I would say that one reason to kind of put the foot down for now, not move on another rate hike until October, is that we're probably going to have a lot more clarity on these risks by October compared to today, particularly when it comes to NAFTA and what housing is going to shake out to look like over the next few months.
And I'd like a take from both of you. I'll start with you, Francis, on what this means for savers. I mean, we talk a lot about, whatever it was 20 years ago when mortgage rates were 20%, but people don't often talk about the fact that, I think my parents had a Canada Savings Bond at like 16.5%. Mm-hmm. We're not there, but we're moving up. Is this good news for savers?
Absolutely. I mean, that's been part of the global central bank narrative since they've gone to the zero lower bound and had interest rates at these multi-decade lows is, well, what happens to savers? What happens to those who are living on a fixed income? So while we tend to talk about tightening as a bad thing or something we need to be afraid of that's going to restrain the economy, there's a segment of the population here that benefits. And those who are living on a fixed income, who are savings, are finally going to start to see those numbers rise. Although I will say this is still very, very low interest rate environment. I certainly wouldn't say that savers are benefiting to a significant amount from a 25 basis point increase.
And that's just it, Keith. You can't start saving until you're out of debt. And it's not like there's this great incentive to get your money into a high interest savings account when it's only gone up by this little.
Right. I mean, the question is, can they do it in advance of the anticipated benefit? Right. Because, if they wait too long and interest rates go up before they've shifted that balance out of debt into assets, they could be in a difficult situation to actually start to dig their way out.
How concerned are you about the levels of debt and what governments or people in general need to do to help people get out now?
I mean, as credit counselors, we're
concerned,
by nature concerned about debt. I would say that when we see people, we're definitely concerned. 1.67, debt to income ratio is kind of a scary figure. I'm no economist, so I can't comment on the macroeconomic. But from a micro point of view, we see people are really tight. We just want to encourage them to really look at tightening up and getting aggressive on getting their debt down. Easier said than done, but
All right, listen, we're going to have to leave it there. But thanks to you both. Francis Donald, Senior Economist at Manulife Financial, and Keith Emery, Director of Operations at Credit Canada Debt Solutions.